Now, as we pivot to the regional piece, I think it's important to look at what are some of the components within the U.S. showing. So manufacturing from Dallas Fed bounced back in February to 14 versus 3.5 estimate, which again is a positive. New orders, shipments, CapEx expanded but that's the good side. And then alongside it, increases in prices paid and delivery times, which is a negative. So again, there's some positive in that. There's some negative in that. 6-month outlook strengthened, but employment dipped and is at the lowest level in a year. So again, kind of a mixed bag. Net, I'd call it obviously a positive, but some of those pieces that are positive also leads to inflation. And that's where we continue this kind of rampant view of where is this going to shake out and what does that mean? And obviously this is a big piece of the energy industry. And continuing an issue with the employment side just points to where there's issues, where wages have to go, and how we're going to continue to see that being pressed higher. Then when we look at Kansas City improved in February to 29 versus an estimate of 25. Shipments and new orders surged. All of that a positive. Prices paid unchanged, very much in line with our views. And delivery times continued to improve. Employment strengthened and backlogs decreased while outlook strengthened. So Kansas City is saying all is well. Like there was not a single piece in there that didn't hit every piece of we're in expansion mode. And that's why when you look at the different components, some areas are doing better than others. And that's why we look at all of them and it's kind of a mixed bag. And that's when we say like, look, we're going to slow. There's going to be pressure, but we're not going into contraction level yet because there's enough pieces of the U.S. economy that are going to be there to support us. The question is always going to be, when does the very fickle U.S. consumer say this is enough? And right now we've seen spits and starts of it, but as you get this inflationary push, that's when we think things are going to start to really roll off. Supplier delivery times, again, improving. Still bad, but still better than they were. Prices received for finished products to a new all-time high. Again, that is more of an inflationary pressure that we've highlighted. Then when you look at Chicago PMI, back to what we had said, the survey was for 62.3. The actual came in at 56.3. The spread between the indices of new orders and inventory dipped below zero, pointing to slower growth ahead. Supply chain strains remained elevated. When you start looking at this on a differentiating level, this is why, again, this is the bright spot. So we gave you the negative spots. So we gave you the really big bright spot, and now this is the big negative spot. And now we're going to look at some of the others to look at how are they going. So Dallas Fed, as we were saying, the survey was at 4.3. It came in an actual 14. Production came down a bit, but still at a fairly comfortable range in terms of where they are. Then you look at unfilled orders coming down. Again, things catching up. Prices paid moving back to the highs. As we were saying, we kind of expect that chevron pattern of pretty stable highs and lows as things remain elevated. And then when you start looking at the underlying pieces of wages and benefits, this is the inflationary piece that we keep talking about. Outside of input costs, the biggest of the expected wages and benefits continue to go up, and another indicator of where inflation is, which is what we're seeing in the E&P space, oil field service space, as we're seeing a lot of that moving higher. Adjusted retail inventories increased. So retail inventories were strong again in January, 1.9% versus 4.7% in December. Level now almost back to pre-pandemic territory. So we've had a quick increase in retail inventories, and this is a mixture of retail sales coming down, but as you see these increases, the benefit to GDP starts to slow, because as you hit this point, then you get this GDP pressure where, okay, well, inventories have already normalized, so that's not going to be the same benefit, which is, again, one of that driving pieces that we've been talking about on that refill of inventories and that buildup of inventory. That was more of that bright spot. Now, when we look at home prices, so an analysis of a home purchase contracts entered into early to mid-February indicates that HPA will continue to be in the mid-teens in February and March. So again, you're still seeing those pressure points. You're still seeing housing prices going up, which is a key piece to you guessed it, inflation CPI, where you're going to continue to see pricing pressures moving up. And this is just looking at the different measures of rent and inflation, where when you look at owner's equivalent rent and how low it is versus the Zillow National Rent Index, there is still a lot of ground to cover, and why we think that the CPI side is not going to see this big drop off, and a lot of that is going to be driven not only based on raw materials, but also as owner's equivalent gets factored in. Then when you look at U.S. private construction spending, you can see that it's obviously very much residential. We have a record amount of multifamily homes under construction. We have a huge amount of single-family homes under construction, but there's a huge delay in terms of when are they finished because of all the supply chain issues that we've been highlighting. So then when you look at the Misery Index 2.0, the combination of CPI and average 30-year mortgage rate has hit 11%, which is the highest since the financial crisis. To give you an idea of some of those pressure points that I think are ignored when you're considering the lower end of the spending bucket, which is obviously right here. So then when we look at January new home sales, they were weaker at negative 4.5% versus the estimate of 1.2. Median sale price was up 13.4% to $423,000 at current sales pace. It would take 6.1 months to exhaust supply of homes, up from 3.6 months a year ago. So obviously a little bit of a slowdown, but it's January. January is typically a terrible time to sell a home. So we want to see how does that continue into March and April when you normally have kind of that spring bump in terms of spending. Construction spending stronger in January at 1.3% versus the 0.1%. Private residential, as we talked about, private residential home improvement, all of those things. Again, still seeing that spending at the home level. But when you start looking at new and used cars and some of these other pieces, searches are picking back up. But also this is when you typically buy cars. Winter is not a big one for it, but you're starting to see some of that picking back up, and you have seen some catch up on the car side, but now you're getting another increase in delays, and not obviously aluminum, steel, nickel, all those things. So you will see some of these pressure points show up again as consumers that were waiting are finally pulling the trigger. But what is that going to happen? What does that mean going forward? Used car price gains rolling over, but still at extraordinary levels. So again, still seeing a lot of that pressure along that front. And then when you look at over the past year, it has collapsed by 13.5% after surging by double digits during the pandemic. And that's the personal savings rate annual change. So you're getting, again, that personal savings rate has come down, which we've been talking about. Then when you look at U.S. retail sales at warehouse clubs and superstores, people are looking for deals. And this is just kind of when you look at savings, when you look at spending, people will go to the replacement. If I'm not going to buy this name brand, then I'm going to go to the store brand. If I can't afford the store brand, well, I'm going to go buy in bulk. And this is kind of that last piece that you see before people say, I just can't keep spending like this. And I think we're coming to the end of that, which again is going to put more pressure on where things are. So that's what we have for you for the remainder of the U.S. Now, in the next segment, we'll talk about Europe, some of the impacts that they're seeing, and where do we see this going from here.